Welcome back to the deep dive. It is Monday, February 16th, 2026. And, we really need to cut through the noise today.
There's a lot of it.
There is. I mean, the market is just staring at Nvidia like it's some kind of magic trick it can't quite figure out. The market cap is sitting at, what, $4.6 trillion?
It's a dizzying number.
Yeah, and the stock is bouncing around $182 to $192 a share. It's wild.
It's the kind of number that, it gives value investors vertigo.
Seriously. But the feedback we're getting from listeners, and frankly what I'm seeing on my terminal, is that people are just tired of the hype.
I get.
They don't want to hear AI is the future for the millionth time. They want to know if this specific company can actually justify that valuation.
Right.
We need to know if the revenue and the margins are going to hold up through the end of this year, 2026, and into 2027, or if this whole thing is about to pop.
That is the only question that matters right now. We aren't here to talk about the philosophy of AI. We are here to look at the balance sheet. And we have a stack of fresh reports right here. Morgan Stanley from January, Goldman's February forecast, and a critical new report from the Grand Pinnacle Tribune that all paint a very specific picture of where the money's coming from.
Okay, so let's get right to it. The street is debating whether the tank is empty, but what you're seeing is evidence of a structural shift that actually secures the next 2 years of revenue.
That's right. If you look closely at the operational decisions they've made, even just in the last 3 months, specifically around their product mix, you see they're essentially burning the boats to secure the island.
Burning the boats? You mean sacrificing their legacy business?
Exactly. All to make sure those 2027 margins hit that 75% target.
You're talking about the gaming news.
I am.
Okay, let's unpack that first, because if you're a gamer, you are probably furious right now. The Grand Pinnacle Tribune reported on February 7th that the RTX 50 series supercards,
The ones everyone was waiting for.
yeah, the high-end gaming GPUs, they're delayed, just gone.
And not because they couldn't make them, because they chose not to.
Right. The report calls it a strategic choice, driven by a memory shortage. But walk us through the business logic here. Why would you annoy your oldest, most loyal customer base?
Well, it really just boils down to raw economics. We are in a global shortage of high-bandwidth memory.
HBM, right.
Yep. So Nvidia has a limited supply of these memory modules. And they have a choice. They can take that memory, solder it onto a gaming card, and sell it to a gamer for maybe, what, $1,500?
If they're lucky.
Or they can put that exact same memory into an AI accelerator, like a Blackwell unit, and sell it to Microsoft or Meta for $30,000 or $40,000.
When you put it that way, it's not really a choice, is it? It's an IQ test.
Exactly. And that decision shows up right here in the Q3 fiscal 2026 numbers. Just look at the split. Total revenue was $57 billion.
Okay.
Data center revenue was $51.2 billion. That is up 66% year over year.
So the data center, the AI factory business, it's basically 90% of the entire company now.
Yes. Gaming brought in, what, about $14.3 billion for the whole year. It's barely a rounding error compared to the AI side. So the first thing you need to understand about the 2026 outlook is that Nvidia is no longer a gaming company.
It's an industrial infrastructure company.
That's it. So the gaming card delay isn't a sign of weakness, it's a sign of extreme margin discipline. They are funneling every resource to the products that keep those gross margins above 70%.
Okay, so they're all in on enterprise. But that brings us to the demand question. We keep hearing about the Blackwell chips, and they are ramping up now. But for the stock to hit the targets, Morgan Stanley is talking about $250, maybe even $330.
Right.
Customers need to keep buying after this current build-out. Why would they?
This is where we have to talk about the roadmap, and specifically a name that keeps popping up in all these reports, Vera Rubin.
Rubin. So this is the platform that comes after Blackwell.
Yes. And understanding Rubin is the key to understanding that 2027 revenue forecast. Right now, companies are buying Blackwell, and Morgan Stanley notes that the assembly time for these systems has dropped from 2 hours to just 5 minutes.
Wow, so they've solved the supply bottleneck for this year.
For this year, yes. But the Rubin platform, which starts shipping late 2026 and then ramps in 2027, is the reason the revenue doesn't just fall off a cliff.
But let me play devil's advocate for a second. Microsoft just spent billions on Blackwell. Why on earth would they immediately turn around and buy Rubin next year? Isn't there a point where they just say, we have enough chips, thanks?
You'd think so, if they were just buying chips. But they aren't. They are buying cost reduction. You have to understand the difference between training and inference.
Okay, break that down for us.
So training is teaching the AI model. It's like sending it to university. It's incredibly hard, expensive, takes months. That's what we've been focused on for the last couple of years. Inference is the AI actually doing its job, answering your query, writing code, making an image. That happens millions of times a day.
Got it.
As these models get deployed to billions of users, the cost of inference, the electricity bill, the cooling, the time, that becomes the biggest single expense for a company like Meta or Google.
Ah, okay.
And the Rubin platform is designed specifically to kill that cost. The data we're seeing shows Rubin cuts inference token costs by up to 10 times compared to Blackwell.
10 times?
Yes. So if you were Mark Zuckerberg and you're staring at a $10 billion electricity bill for your AI assistants, and Nvidia comes and says, buy this new system, and we can cut that operating cost by 90%.
You don't have a choice. You have to upgrade.
You have to. It's deflationary technology. You spend capital expenditure up front to save operating expenditure forever.
That's the lock-in.
That is the lock-in. And Rubin also requires 4 times fewer GPUs for training while being 5 times faster. So it saves rack space. It saves cooling. This is why analysts are so confident that the CapEx cycle won't crash in 2027. The upgrade isn't optional if the hyperscalers want to stay profitable.
That makes a lot of sense. It's not just faster, it's cheaper to run.
Okay, so let's look at what that does to the actual financial projections, because the numbers in these reports are, they're getting hard to wrap my head around.
They're massive.
So we're closing out fiscal year 2026 that ends January 2026 with estimates around $217 billion in revenue. That's our baseline.
Right.
But looking ahead to fiscal year 2027, the consensus on the street is $326 billion.
Yeah,
And I'm looking at this Motley Fool analysis that says even that is too low. They're projecting $350 billion.
And Goldman Sachs goes even further out. They see a path to over $513 billion by 2028.
$500 billion in revenue. That's,
Yeah.
Who has that kind of money to spend?
The hyperscalers do. We have the data on their spending. Microsoft spent $37.5 billion in CapEx in just one quarter. In one quarter.
One quarter. And Meta is guiding for up to $135 billion in spending for 2026 alone. Credit Sites estimates the top 5 tech giants will spend nearly $602 billion this year.
And since Nvidia is really the only game in town for this kind of infrastructure, a huge chunk of that $600 billion just flows directly to them.
Correct. They are the utility company for the AI era. You just can't run the grid without them.
But here's the thing that usually kills companies in this spot: margins. When you sell hardware at this scale, it becomes a commodity. Dell doesn't have 75% margins.
No, they don't.
Yet Nvidia is forecasting gross margins to hold at roughly 75% all the way through 2027. How are they defying gravity on this?
Because they aren't selling a commodity. They are selling a walled garden. It's the iPhone effect, but for data centers.
Okay.
Nvidia sells the rack, the networking switches, and crucially, the software layer CUD.
The moat.
It's a very deep moat. If a company wants to switch to a competitor, they can't just unplug an Nvidia chip and plug in an AMD chip. It doesn't work like that.
You have to rewrite everything.
You have to rewrite your entire software stack, retrain your engineers. The switching costs are incredibly high, and that gives Nvidia immense pricing power. They're selling a complete system, not just a part.
Plus, demand is still just. It's outstripping supply. Jensen Huang mentioned a backlog.
He did. He threw out a number that just stunned people. He said the pipeline for Blackwell and Rubin could cover $500 billion worth of orders.
$500 billion.
Now, you have to be careful. A pipeline isn't the same as a signed contract. But even if only half of that is real, it essentially underwrites their revenue for the next 18 months.
Which brings us to the valuation, because if you do the math, $350 billion in revenue with a 56% net profit margin.
You're looking at nearly $200 billion in pure profit. Then you put a 40x multiple on that, which is pretty standard for high growth, and the math supports an $8 trillion market cap.
Which implies a stock price over $300 a share.
That's why Morgan Stanley has that $330 bull case target.
It sounds completely insane, but the math does check out, if the growth holds. Okay, but I want to pivot to something that I didn't see in the headline numbers, but I think is crucial.
Okay.
We've been talking about Microsoft, Meta, Google, but the Grand Pinnacle Tribune and a few other sources touched on a completely new customer base.
You mean the sovereign AI thesis?
Exactly. This idea of nations as customers.
This is potentially the biggest unpriced factor for 2027. We are seeing a major shift where countries, Germany, Japan, Saudi Arabia, India, they're all realizing they cannot rely on American tech giants for their national AI infrastructure.
It becomes a national security issue, right? You don't want your citizens' data or your government data sitting on a server owned by a company in Redmond, Washington.
Exactly. They want data sovereignty. They want to own the intelligence. So what are they doing? They're building their own AI factories.
Right, like that industrial AI cloud with Deutsche Telekom.
Or the partnerships with major car manufacturers. So now, Nvidia isn't just selling to 4 or 5 tech CEOs. They are selling to entire nation-states.
And nation-states are very different customers.
Very different. They weren't worried about quarterly profits. They're worried about national competitiveness over the next decade. They're basically price insensitive. If Saudi Arabia decides it needs a sovereign AI cloud to run its logistics and power grids, it's going to buy the best hardware available, no matter the price.
So that diversifies the risk. If Amazon slows down spending for a quarter, Germany might speed up.
Precisely. It broadens the customer base. It moves AI from being a tech sector story to an industrial utility story. And that is what really supports that $350 billion revenue floor.
There is also one other geographic wildcard we have to mention: China.
Yes. The NASDAQ report from February 15th had a major update here.
For a while, China was basically written off because of the export bans.
It was. But it seems they found a middle ground. The H200 chips, which are compliant with U.S. regulations, are now greenlit for export.
And what's that market worth?
Jensen Huang estimates the Chinese market could be worth up to $50 billion annually.
$50 billion. That's the size of the entire company just a few years ago.
And most analysts had taken China completely out of their 2027 models because it was too risky. If that market comes back online, that is pure upside on top of the forecasts we were just discussing.
Okay, I have to play the skeptic now. We've painted a very, very rosy picture.
It is rosy.
$350 billion in revenue, nations buying chips, China coming back online. But Morgan Stanley has a bear case where the stock drops to $150. We have to look at what could derail this train.
We do. And the biggest risk isn't that AI stops working. It's that the customers get tired of paying the Nvidia tax.
You mean the hyperscalers themselves?
Yes. Look, Satya Nadella, Sundar Pichai, Jeff Bezos, these guys did not build trillion-dollar empires by writing blank checks to vendors forever.
Good point.
Every single day they pay Nvidia a 75% margin is a day they are furiously trying to engineer a way out of it.
So they're building their own chips, the ASICs.
Custom silicon. Google has their TPU, Microsoft has Maya, Amazon has Trainium. Their goal is to offload as much work as possible onto their own cheaper in-house chips. If they can move 30 or 40% of their internal workloads off NVIDIA GPUs, then NVIDIA's pricing power starts to collapse.
So the risk is that NVIDIA goes from being the only option to being just the premium option.
Exactly. And then there's the efficiency paradox we saw mentioned in that Constellation Research note about DeepSeek.
This is the idea that the software is getting so smart it needs less hardware.
Right. DeepSeek proved you can train a really powerful model with way less compute than people thought. If AI models become incredibly efficient, do we really need to keep building $100 billion data centers?
Wow.
If demand for compute flattens because the code gets better, then the revenue growth just stops.
What's Jensen Huang's counter to that? He has to know that's a threat.
His argument, and it's a strong one, is that we are moving from generative AI to agentic AI, reasoning AI. An AI that doesn't just spit out an answer but actually thinks for 20 seconds, considers alternatives, and plans a multi-step solution.
Kind of like a human working through a complex problem.
Yes, and that reasoning process requires exponentially more compute. Huang argues that even if the models get more efficient, the tasks we ask them to do will get so much harder that we'll need 100 times more processing power anyway. It's the Jevons paradox. Efficiency leads to more consumption, not less.
So the ultimate bet is that the demand for intelligence is infinite.
That is the bet.
There is one last risk from that Grand Pinnacle report, the supply chain. We started with the gaming delay. If they physically can't make the chips, if TSMC can't build the wafers or the packaging, they just leave money on the table.
It's a very real constraint. Though I will say that assembly time dropping to 5 minutes suggests they are optimizing the part of the chain they can control. But yes, they are still beholden to physics and global supply chains.
So let's bring this all together. We wanted to know if Nvidia can hold its momentum through 2027.
And the evidence we have points to yes, but with some big caveats.
Okay, let's recap the pillars of that bull case. Number one, the strategic pivot. They've essentially abandoned the gaming consumer to pour every single resource into the high-margin data center business.
Which is now 90% of their revenue.
Number two, the product roadmap. Blackwell is the now, but Vera Rubin is the lock-in. It offers the kind of cost savings that basically forces hyperscalers to upgrade in 2027.
Securing that next cycle of CapEx.
Number 3, the customer base is expanding. It's not just tech companies anymore, it's sovereign AI. Nations are entering the market as price-insensitive buyers.
Which creates a nice floor for that massive $350 billion revenue projection.
And finally, the financials themselves. Those 75% gross margins seem sustainable because of the software moat, despite the very real threat of custom silicon from competitors.
It's a company that's operating at a scale and a profitability we just haven't really seen in hardware history.
It is going to be a fascinating year. For everyone listening, mark your calendars for February 25th. That's the next earnings call.
That is the moment of truth.
Listen specifically for any updates on the Rubin timeline and any mention of a sovereign AI backlog. That's what's going to tell us if this 2027 thesis is really on track.
And I'll be watching the margins very closely.
We'll be right here to break it all down when it happens. Thanks for joining us on this deep dive.
Thanks for having me.